Hey guys, welcome to the channel. This video will be an overview of my investing journey and strategy. For today's agenda, I'll first introduce you to the channel. Second, deep dive into the calculated leverage strategy. And third, walk you through my Robinhood account. Who am I and why am I doing this? I'm 24 years old, looking to build long-term wealth at an accelerated pace while actively managing the risks. This channel documents my real-time journey using a calculated leverage investing strategy. We'll explore the tactics I use, the trades I make, and the lessons I learn along the way. Important, this is for entertainment only. Note, this strategy requires an understanding of margin and optionally basic options trading. If you are not familiar with these concepts, I recommend watching the videos in the description. Step number 1. I start with my initial investment capital. This strategy does not require me to contribute money often, except for adding funds during severe market downturns. Step number 2, I allocate 70% of my capital to EGGY and 30% to IDVO. Why I picked ETFs at these allocations will be discussed in the subsequent slides. Step number 3, I introduce a margin loan to leverage my initial capital and actively manage my risks by monitoring and maintaining a large margin buffer. My buffer is determined by a rule I have developed based on CNN's Fear and Greed Index. I can also add money from my paycheck into my account to reduce the chances of a margin call. Optional step. I generate income to help offset the interest on the margin loan by selling puts with around 85% probability of profit on stocks with high implied volatility and consistently growing revenue. If I am assigned shares on selling puts, I switch to the wheel strategy by selling covered calls on those assigned shares until I have at least broken even. Then I sell a stock. Step number 4. The outcome of this strategy is accelerated portfolio growth. Now I'll cover my intent behind my core portfolio picks and details on the Fear and Greed Index reference for margin usage. What are EGGY and IDVO? EGGY is an ETF that seeks to generate monthly income through a strategically selected portfolio of US large cap companies. IDVO is an ETF of international companies with a history of dividend and earnings growth, along with a tactical covered call strategy on individual securities. Here's a total return chart of VU, EGGY, and IDVO overlaid. While past performance, especially that of a limited time frame, is not indicative of future results, EGGY and IDVO have beaten the S&P 500 since December 2024, while having lower worst drawdowns during the April 2025 tears. IDVO's allocation at 30% was a play to diversify internationally and lower geographical risks. Furthermore, these ETFs have a low margin maintenance ratio on Robinhood. However, the most important reason why these ETFs were picked instead of traditional ETFs like SPMO and IDMO was that they generate income. Distributions from these type of ETFs are considered cash to Robinhood, thus increasing the margin they lend me. Increasing my allowable margin is critical for the next step, having a simple method to know how much margin to use. What is CNN's Fear and Greed Index, FGI? The FGI measures overall market sentiment from 0, extreme fear, to 100, extreme greed. It shows whether investors are mostly worried or overly optimistic. This is the grand equation, Y equals target buffer. This system provides a single data-driven target buffer Y from our margin account. The formula's engine is an S-curve that reads the Fear and Greed Index, X. I adjust the required safety margin, buffer, based on sentiment. I require a large buffer during greedy markets to decrease my risk, and a small buffer during fearful markets to opportunistically increase my risk and leverage. The formula also has simple on-off switches to accommodate my option strategy. While a put is sold, a temporary negative minus 5% reduction wheeling discount is applied to my target buffer. If I'm assigned shares, a negative 2% reduction grace period is then applied to the buffer for managing the new stock position, which helps prevent overextending my put selling capacity. I aim to maintain my actual buffer at or above the target buffer, using a 1% tolerance as a simple trigger. If my actual buffer falls outside this range, I initiate a trade, buying or selling, to bring it back to the target. For example, as FGI fluctuates day by day, if the equation tells me my buffer should be 60% and mine is currently at 58%, I will sell shares to increase my buffer because 58% is outside, 60% plus or minus 1%. This is a cheat sheet I use to determine how much margin I should use. This is an optional step, selling puts or wheeling strategy. So the first step is stock selection. I find promising stocks by first examining the holdings of ULTY or similar ETF. This gives me a list of companies known for having high options volatility, IV, which means they pay high premiums. Fundamental filter, step number 2. From that list, I only keep stocks with a clear, consistent history of growing revenue. This ensures I am selling puts on companies I wouldn't mind owning. Number 3, trade entry rules. I only sell a put when 2 conditions are met. Timing, RSI. The stock's relative strength index, RSI, on the daily chart must be less than 50. This ensures I sell the put when the stock is relatively weak and has room to rise, improving my odds of winning. Rule number 2, safety, probability of profit. I only sell puts with a 85% probability of profit. This means the option premium I collect has a high statistical chance of expiring worthless and being kept. Step number 4, margin advantage. Once a put is sold, it uses my margin as options collateral on Robinhood. This is a significant advantage because unlike a typical margin loan, no interest is charged on this collateral, allowing me to trade with greater efficiency and lower costs. In essence, my strategy is find high quality, high premium stocks when they're temporarily weak. Use high probability puts to collect fee-free income and aggressively avoid assignment. Now, I'll be walking you through my Robinhood account, including my holdings, positions, margin buffer, and my 1-week performance since implementing the strategy. Okay, now we're in my Robinhood account. If you look at the stocks section, you can see that my holdings are currently EGGY, Google, IDVO, and random stocks. Ignore these random stocks because I'm just trying to have fun. Also, ignore Google, even though it's a big portion of my portfolio, because I'm stuck holding it because of this covered call. Okay, options, SoFi put. So I sold this put because I saw an opportunity. It's RSI 3-month, which is what I prefer to look at, and 1-day interval is actually below 50. As you can see here, it was trading around 40 when I sold it. Okay, now let's take a look at margin. So currently, my margin buffer is 51%. Currently, the Fear and Greed Index is 54. And from that equation, my target buffer should be 57.9. However, according to the formula, because I have a sold put, my target buffer should actually be -5. And because I have a tolerance of 1% on top of that, it should be this. So right now, my buffer is actually lower than the target buffer, which means that I should probably sell a little bit of stocks. to reach this buffer. However, I'm comfortable with the level I am at right now. This has been my 1 week performance. I'm looking forward to the future weeks. Thanks for watching.